Hello everyone, welcome back to the Intelligent Research channel. This is Victor here. In today's video, I'm going to explain why I think McDonald's stock is still one of the best defensive stocks, especially during a market correction. I will show you how to calculate McDonald's stock's intrinsic value in this video, so you will know when it becomes undervalued. Before I start, I want to give you some context first. At the time of making this video, the market is in a large correction. Most stocks are down at least 10% from the recent high in July because of many macro headwinds. These macro headwinds include high inflation around the world, high GDP growth in the US, the war in the Middle East, as well as the war in Ukraine, the very high US federal deficit, high interest rates that will likely stay longer, and of course the very high US Treasury yields that are affecting both the bond market as well as the stock market. High US Treasury yields always affect stocks the most, especially tech stocks that are very rate sensitive. This is because investors can buy US Treasuries that can pay them 5% or more in interest. More importantly, US Treasuries are considered risk-free, especially the short-term US Treasuries, if you hold them until maturity. If most US Treasuries are paying you 5% or more in interest, it makes stocks much less attractive to buy. Also, high US Treasury yields always increase the borrowing costs for both consumers and businesses. Higher borrowing costs will cause many consumers to slow down their spending, cause many businesses to invest less and hire fewer employees, and eventually cause the economy to slow down. Another thing we should consider is this: if you like to invest in stocks, the 10-year US Treasury yield is considered the benchmark rate to value stocks. If the long-term 10-year US Treasury yield is higher, we have to use a higher discount rate to value stocks. When the discount rate is higher, the intrinsic values of stocks will become lower. This is because we have to discount their future earnings to the present day at a higher rate. This is one of the biggest reasons that most stocks are down more than 10% since the most recent high in July. As of now, you can see that all the short-term US Treasuries are above 5%. The long-term 10-year US Treasury is very close to 5%. And the 30-year US Treasury bond is already above 5%. Now, as long as US Treasury yields are very high above 5%, it makes sense for many investors to invest in money market funds, CDS, and US Treasuries that are essentially risk-free if you hold them until maturity. But the opposite is true. Once US Treasury yields start to come down a lot, many investors and money managers will start investing in equities again, which will cause the entire market to recover. Going back to McDonald's stock, McDonald's is considered one of the best defensive dividend growth stocks. McDonald's has a very resilient business model. Even when the economy is not doing well or when there's a recession, many people still like to eat at McDonald's. This is because McDonald's most popular foods such as McChicken burger, Big Mac, fries, and chicken McNuggets are very addictive. They are also very affordable for most customers. At the time I'm making this video, McDonald's stock has dropped a lot in recent months. Wall Street is very concerned that weight loss drugs such as Ozempic and Wegovy will cause many consumers to change their eating habits, cut back their spending on foods that have very high calories, and therefore affect McDonald's sales going forward. So in this video, I will talk about why I think McDonald's is still one of the best defensive dividend growth stocks over the long term. I will talk about McDonald's biggest risks to consider, McDonald's financials, McDonald's competitive advantage and long-term prospects, McDonald's stock valuation, and will I buy McDonald's stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Of course, past performance does not guarantee future results, but I still want to show you McDonald's past performance here. Here, you can see that McDonald's still underperformed the S&P 500 by a large margin in the past 1 year. This is because investors are concerned that weight loss drugs such as Ozempic and Wegovy will change consumer behaviors and cause many consumers to eat less fast food going forward. McDonald's is the most popular fast food franchise in the world. Without this large drop, McDonald's would have performed very similar to the S&P 500 in the past 5 years, with less volatility. I think the important question is whether or not these weight loss drugs will change consumer behaviors and cause many consumers to eat less at fast food restaurants going forward. Wall Street tends to overreact to negative news. In this case, I believe Wall Street is overreacting to the news about weight loss drugs such as Ozempic that may affect fast food businesses going forward. According to the Wall Street Journal, the drugs which suppress patients' appetites have exploded in popularity in the US, straining manufacturing capacity. Morgan Stanley has projected that 24 million people, or nearly 7% of the US population, will be taking such medications in 2035. Those people could cut their daily calorie consumption by as much as 30%, according to the firm, which surveyed over 300 patients. If 2/3 of Americans are the target audience, it's a huge thing. This refers to the portion of the US population that's considered overweight. Some Wall Street analysts and food industry consultants said they don't view Ozempic, made by Novo Nordisk, and other weight loss drugs as a big risk for now. The drugs remain expensive and inaccessible to many Americans, they said, and widespread or long-term adoption isn't guaranteed, with some people experiencing unpleasant side effects such as nausea and diarrhea. It's also still unclear which foods patients may opt to eat while taking the drugs. This is my prediction. I believe the market is overreacting to the news about weight loss drugs causing people to eat less food. Right now, there's a huge demand for weight loss and anti-obesity GLP-1 drugs, such as Ozempic and Wegovy from Novo Nordisk. There's just not enough supply to meet all the demand. According to this article, it's very expensive to buy Ozempic. For example, 1 month's supply of Ozempic can easily cost between $900 to $1,000. Also, many insurance companies do not cover these weight loss and anti-obesity drugs. If you need to buy Ozempic, it will likely cost you as much as $12,000 each year. Many people will not be able to afford to buy Ozempic or other similar weight loss drugs if they cost at least $900 each month. I think the drug companies making these weight loss drugs are targeting higher income customers who have more disposable income and savings. McDonald's is targeting different customers. McDonald's customers are generally much more value conscious. Also, we don't know all the side effects of using these weight loss drugs every month. If you skip taking these weight loss drugs for a month or two, you will likely go back to your old eating habits. It's very hard to change consumer behaviors. I think using weight loss drugs to make people eat less and to make people cut back their consumption of foods that have high calories is not a long-term solution. This is why I think these weight loss drugs will not have a huge impact on McDonald's sales over the long run. I believe McDonald's biggest risk is this: consumers are becoming more health conscious compared to before. McDonald's foods are generally not very healthy compared to other restaurants such as Chipotle Mexican Grill. McDonald's did have declining sales for many years before 2020 because consumers were changing their eating habits. Consumers want to eat healthier food with fewer calories, less fats, and less artificial substance. Consumers want to eat chicken meat and beef that do not have antibiotics. McDonald's revenue was the lowest in 2020 because its business was greatly impacted by COVID-19. Now McDonald's revenue has recovered a lot since 2020. During this period, you can see that McDonald's operating income and free cash flow per share have been growing gradually. This shows that McDonald's has a very resilient business model, even though the market went through two major changes. First, consumers are becoming more health conscious than before. And second, COVID-19 has caused consumers to use a lot more food delivery services, such as Uber Eats. I think McDonald's has adapted to these two major changes. This is why McDonald's sales have been growing again since the bottom in 2020. Here's another risk we should consider. McDonald's has been buying back a lot more shares than the company's retained earnings over the years. This is why McDonald's total shareholders' equity or book value is negative now. This trend will continue because McDonald's will continue to return more capital to shareholders by paying out dividends and buying back more shares every year. This is very common for mature restaurant businesses that earn a lot of profits and free cash flows each year. For example, Starbucks also has a negative book value similar to McDonald's. While I'm making this video, McDonald's Q3 earnings are not out yet, so I'll just use its Q2 earnings as an example here. If you look at this balance sheet, you can see that McDonald's has around 1.6 billion of cash equivalents as of Q2. In comparison, McDonald's has around 48.5 billion of debt and lease liabilities. McDonald's debt level and these liabilities seem to be a lot compared to McDonald's cash. If you look closely here, you will see that McDonald's debt and lease liabilities are mostly long-term. I think this is reasonable because McDonald's is in the real estate business. McDonald's is not just a fast food business. McDonald's invests in many restaurant locations and buy many land and buildings, so it makes sense for the company to have more long-term debt and lease liabilities to support its restaurant locations. This is very similar to when you buy a rental property. When you're investing in a commercial property or a residential rental property, it doesn't make sense to use cash to buy it. Most of the time, if you can get financing from a bank that can give you a low interest rate, it will make sense for you to borrow to invest in a real estate property instead of buying it with cash. This is why McDonald's has around 48.5 billion of debt and lease liabilities. Most of it is used to invest in long-term real estate assets such as land and buildings. In terms of other financials, McDonald's operating margin is well above 40% and its free cash flow margin is well above 25%. This shows that McDonald's is a very profitable business. I want to talk about McDonald's competitive advantage and long-term prospects here. Morningstar gave McDonald's a Y economic moat rating. These analysts did a great job explaining McDonald's competitive advantage. Low barriers to entry and minimum switching costs render the restaurant industry very competitive, making it difficult for most operators to develop an economic moat. Those who are able to do so, as we see it, focus on generating pricing power through a substantially differentiated and recognizable brand or by developing structurally lower operating costs, generally supported by scale-driven pricing advantage and leverage system-wide investments in marketing and technology, while spreading administrative expenses over a large revenue base. In our view, McDonald's boasts a wide economic moat with pricing power, a healthy network of franchisees, and successful international replication underpinning its brand intangible assets. We also believe that McDonald's benefits from a durable cost advantage with its dominant global scale allowing to procure food and paper at favorable prices, to leverage marketing and technology investments across its global footprint, and to secure lower rates from third-party delivery aggregators. Our Y moat rating implies the assumption that the firm can continue to earn positive economic returns for the next 20 years. To this point, the firm has earned an average return on invested capital, inclusive of goodwill, of 20% over the last 5 years, against a weighted average cost of capital as we calculated of 7%. Our 10-year forecast sees an average adjusted return on invested capital of 28%, with our 2032 projection of 32.5%, outstripping the firm's pre-pandemic average due to positive operating leverage and refranchising. The strength of recent technological investments, the company's strong performance during a trying 2020, during which its return on invested capital of 14.5% still outperformed its cost of capital, and ongoing success in international markets leave us confident that McDonald's will continue to earn excess returns over an extended horizon. I believe McDonald's has these two biggest competitive advantages, branding and cost advantage, which are very hard for competitors to copy. First of all, let's consider this. When you think about fast food, which restaurant will you think about first? I'm pretty sure you will think about McDonald's first. Most consumers will think about McDonald's first when they think about fast food that is very affordable, fast and convenient. McDonald's branding is its most important competitive advantage. It's almost impossible for other competitors to copy McDonald's branding and its number of restaurants locations around the world. McDonald's has the most fast food restaurants locations around the world, and its branding is recognized everywhere around the world. A lot of McDonald's foods such as chicken burgers, the Big Mac, McNuggets, and fries are very addictive. They are still very affordable even when inflation is high. This is why many people still eat at McDonald's even when there's a recession. McDonald's has a very large cost advantage compared to many fast food restaurants. McDonald's sells a lot more burgers, sandwich, meats, fries, drinks, and other snacks compared to competitors, so it's much easier for McDonald's to negotiate lower pricing from its suppliers. McDonald's is known for its branding and marketing. To reduce all the marketing and operating costs, McDonald's can spread out most of its marketing and operating costs across the 40,000 plus restaurants and charge franchisees higher fees to cover the company's marketing and operating costs. It's almost impossible for other competitors to copy McDonald's branding, cost advantage, and economies of scale. For example, even when inflation is high, McDonald's can still keep its foods very affordable without raising prices too much, while many restaurants have to increase their prices a lot. I said this earlier, the main concern or the biggest risk is that McDonald's offerings are generally less healthy compared to restaurants like Chipotle Mexican Grill, so McDonald's will need to keep improving its menu to be healthier going forward. At the time of making this video, McDonald's comparable store sales are growing again. I think the biggest reason is that McDonald's has improved its menu much more in recent years. Some of McDonald's offerings are healthier than before. McDonald's is using more meats that have much fewer antibiotics compared to before. McDonald's is still very affordable even when inflation is high. Digital sales, food delivery, and drive-thrus are becoming more popular now. All these things combined have helped McDonald's grow its sales again. For example, according to these financials, McDonald's global comparable sales have improved nearly 12% year over year. Going forward, McDonald's is planning to grow more by opening more locations outside of North America. The company is planning to add 1,500 restaurants in 2023. McDonald's already has more than 40,000 restaurants in over 100 countries. Around 95% of McDonald's restaurants are franchised to independent local business owners. McDonald's only owns about 5% of the restaurants. Here's the important part you want to know. This shows where McDonald's earns the most revenues and profits. McDonald's makes the most revenues and profits from franchise restaurants. For example, if you look at these financials here, you can see that franchise restaurants contribute about 89% of total restaurant margins, while McDonald's company-operated restaurants contribute about 11% of total restaurant margins. Let's go deeper here. McDonald's earns the most revenues and profits from rents and royalties. Franchisees or the independent business owners that run the franchise restaurants have to pay a lot of rents and royalties to McDonald's every month. Typically, franchisees have to pay 4% of royalties for existing locations and 5% of royalties for new locations based on monthly gross sales to McDonald's. As long as most of McDonald's franchise restaurants are generating higher sales, McDonald's will earn higher royalties from franchise restaurants in most years. The rental income is very stable for McDonald's. Typically, most franchises don't own the land and buildings, so they have to pay rents to McDonald's every month. McDonald's owns most of the land and buildings. Typically, rents increase over time, and some of the rents are based on a percentage of monthly gross sales. This means McDonald's will likely earn higher rents from franchisees over time. You may not know this, but McDonald's is not just a fast food restaurant company. McDonald's is also a real estate holding company. According to Investopedia, McDonald's is unique in that it owns 45% of the land on which its restaurants sit and 70% of the buildings. The rest it leases, and all franchisees pay rent to McDonald's on a monthly set amount or percentage of revenue basis. I want to show you McDonald's balance sheet here. At the time of making this video, Q3 earnings are not out yet, so I'll just show you the Q2 financials here as an example. McDonald's has around $24 billion of net property and equipment. This includes McDonald's investments in land and buildings for restaurants. But this $24 billion does not reflect the fair values of McDonald's real estate investments. Based on what I know, the $24 billion is mostly calculated at cost, net of depreciation and amortization each year. This means the balance sheet is likely understating McDonald's real estate investments' current market values. Typically, McDonald's invests in prime locations, so many McDonald's restaurants' land values should increase substantially over time. If I have to make an educated guess, I believe McDonald's real estate assets should be worth much more than $24 billion. This is because the $24 billion here is calculated at cost, net of depreciation and amortization. Based on what I know, it does not reflect the current market values of McDonald's real estate investments. I want to show you this consensus revenue estimate from Seeking Alpha. It shows McDonald's expected growth rates going forward. In 2023, McDonald's revenue is expected to grow around 9.5% year over year. This is higher than McDonald's past revenue growth rates. I think McDonald's is benefiting from the current high inflation. Consumers are eating at McDonald's more than before, since McDonald's is still very affordable, especially when food inflation is high. After that, McDonald's revenue is expected to grow mostly between 5% and 6.5% each year. I think these expected growth rates are very conservative. McDonald's is planning to open more locations going forward, especially outside of the US. I think McDonald's revenue growth will be slightly higher, between 5% and 7% each year over the next 5 years. McDonald's earnings per share growth is expected to be much higher than its revenue growth over the next 5 years. This is because McDonald's will continue to buy back more shares every year and improve its operating margin over time. This will increase McDonald's earnings per share and free cash flow per share over time. I want to show you how to calculate McDonald's stock's intrinsic value here, so you will know when McDonald's becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define McDonald's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 10% here. You can use a higher discount rate here if you want to be more conservative. Based on the competitive advantage and the long-term prospects I talked about earlier, I believe McDonald's revenue will grow at a compound annual growth rate CAGR between 5% and 7% over the next 5 years. I'm assuming McDonald's will continue to improve its food menu to be healthier and expand to more locations going forward. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that McDonald's revenue will grow at a CAGR of 5% over the next 5 years. If we forecast McDonald's free cash flow over the next 5 years and discount the free cash flow to the present day, McDonald's intrinsic value should be around $157 billion for the entire company, or $214 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that McDonald's revenue will grow at a CAGR of 6% over the next 5 years. Then McDonald's intrinsic value should be around $166 billion for the entire company, or $225 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that McDonald's revenue will grow at a CAGR of 7% over the next 5 years. Then McDonald's intrinsic value should be around $174 billion for the entire company, or $237 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, McDonald's intrinsic value should be around $226 per share. I also used a forward price to sales valuation model here to estimate McDonald's intrinsic value, which should be around $211 billion for the entire company, or around $288 per share. If we take the average of both valuation models here, I believe McDonald's intrinsic value should be around $257 per share. This means I believe McDonald's is likely fairly valued or slightly undervalued at the time making this video. Morningstar gave McDonald's a much higher fair value of $285 per share. My intrinsic value is much more conservative than Morningstar's fair value. So will I buy McDonald's stock? Personally, I'm not planning to buy McDonald's stock now because I want a bigger margin of safety before I want to buy McDonald's stock for the long term. At the time making this video, I don't have McDonald's stock in my portfolios. I would consider investing in McDonald's if it's 5% or 10% below its intrinsic business value. I mainly invest in higher growth companies that have very large economic moats, great management, great products and services, great long-term growth prospects, increasing earnings, and increasing free cash flow over time. My long-term investing strategy is to invest in the best businesses that are undervalued, keep buying their shares when they're undervalued, and hold them for the long term so their intrinsic values can grow exponentially over time. At the time I'm making this video, the market is still in a large correction, so I'm planning to buy more of the best businesses that are below their intrinsic business values. For example, I like to invest in Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla, Visa, and MasterCard whenever they're undervalued. This is just my personal investment strategy. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.